Hi, I'm Jeff Sarti, CEO of Morton Wealth.
And I'm Meghan Pinchuk, Chief Investment Officer, Morton Wealth.
I'm really excited to have this conversation today. We're going to be doing our quarterly market review. A lot to talk about, a lot in the global landscape, from geopolitical issues to conversations around interest rates, inflation. But let's start with stocks. Stocks have been really running up a lot lately.
Yes.
After a tough 2022, they were up, call it 25% or so in 2023. But what's happened in recent months over the first quarter, it's even accelerated from there. Stocks were up about 10% in the first quarter. They've given a little bit of that back in April, and we'll talk more about that. But let's talk about why stocks are up so much. Earnings are up, but earnings are up only a little bit.
Not that much.
Not that much yet. Stock price appreciation has really moved up at a much faster rate. So why are stocks up so much?
We think it's really a story of inflation and interest rates, and the market is watching these two metrics like an absolute hawk and reacting strongly in either direction. So if you go back to 2022, previous to that amazing rosy scenario you described, it was a bad environment for stocks. Stocks were down. S&P 500 was down about 18% in 2022. So 23 to a large degree was sort of a retracement of that, where it was a recovery from that loss.
And that 2-year period, basically stocks were flat, big drop down and the big move up. Stocks were flat over
Right, but basically 2022 was the period where inflation was rising. And so inflation got all the way almost a little bit under 10%. And so there was a lot of concern around that. The Fed went through their fastest rate hiking cycle in history, where they were behind the curve, and they basically had to raise rates very quickly to try to catch up with inflation and keep it under control. So markets reacted negatively to that. 23 was the reverse, where now inflation started moderating and the rate raises at least slowed down or stopped. And so there was a lot of optimism coming into 2024 that now inflation was going to keep moderating, and that basically interest rates actually would come down. So going into this year, the market was pricing in 7 rate cuts. And so they were saying, okay, great, the Fed's going to just be cutting rates. We're going to go back to the easy money environment. And so that was a lot through the first quarter. That expectation, that optimism was what drove a strong return, we think. Coming into April now, inflation has started ticking up again. So not crazy, but it started rising instead of falling. And because of that now, the market has given back actually a lot of that first quarter gain. And at this point, there's now talk of maybe 1 or 2 rate cuts
instead of the previous 7.
Instead of the 7. And then even some people are talking about, does the Fed have to hike rates again, in the event that inflation continues to tick upward? So now looking forward, it's more about earnings. As you mentioned, there's this issue of the earnings have grown, but not anywhere near as much as prices. So obviously that has to have an effect on valuations.
It does have an impact on valuations, and the end result is stocks are getting more expensive. Because if we revisit back to PE ratios, price to earnings, earnings have gone up, the denominator of that equation, but prices have gone up even further. So yeah, stocks are expensive. The price to earnings ratio on the S&P 500 right now, it's in the low 20s. And to put that into context, that's higher than it's been really since the late 1990s dot-com boom. Even by some other metrics, let's say price to sales, we're actually even exceeding the dot-com valuation. So prices are expensive. And it's a little bit of a story of the haves and the have-nots. The haves being, we all know, the Magnificent Seven.
Yes, the new acronym.
The new acronym, right? That's the technology companies like Apple, Microsoft, the NVIDIAs of the world. Those companies are doing very well, obviously. They are growing their earnings, but even with those companies, the prices have moved up at a faster rate than their earnings, so their valuations have gotten more expensive. What about the other 493 companies in the S&P 500? Those earnings have more stagnated in nature, yet those stock prices have gone up as well. So again, it's a story of expanding valuations.
Well, what about international? Is that a different story?
It is a different story, and we, of course, have some international exposure in our client portfolios as well. International stocks are cheaper. We're always going to be more heavily tilted towards domestic or U.S. stocks, and that makes a lot of sense. Typically, the U.S., we are the superpower of the world, a lot of advantages. Europe, as an example, is somewhat stagnating. Even the UK is in recession. So there's a lot of reasons why international stocks are cheaper. That being said, they're too cheap from our point of view, at least on a relative basis. US stocks are always going to be more expensive, but the discrepancy between those two is about the widest it's ever been in terms of valuations. So for that reason, we think it makes sense to at least have some allocation to international stocks.
So on the bond side, bonds are really at this point incredibly volatile. People think of that as the safe asset class, but bonds have actually been where a lot of the volatility is. In 2022, that was the worst year ever for traditional bonds. So now your corporate and your government bonds on record. And then 23, they actually were doing poorly. They eked out a gain in the end. And so now going into this year, bonds are negative again. And it all is tied back to interest rates. And so interest rates coming up is obviously bad for bonds. That's not an opinion thing. That's just pure math. And so where we, I think, have done a really good job navigating this minefield is we have not taken on a lot of interest rate sensitivity. So the bonds that we're holding for clients on the liquid side tend not to have a lot of that sensitivity where if rates go up, we really, it doesn't impact us particularly. The flip side is if they go down, it also doesn't help. We're looking for other drivers of return.
And you use the word minefield. It really has been. I mean, over the last several years in 2022, you mentioned the bond index was down 13%. I mean, we largely avoided that. Then it was up in 2023. Year to date through yesterday, I think the bond index was down about 3%.
Yeah, so it's been a challenging period. And so all these, again, there's just a lot of short-term things. And obviously we are on top of all these short-term trends and what's happening day to day with inflation and rates and all that stuff. But I will say we spend also a lot of time, not just on those short-term things, but thinking about the long term. And with interest rates being higher, the effect that is going to have on us as a country, on our debt and all those different pieces. And so, Jeff, I think your quarterly perspective letter is going to be coming out soon,
hopefully in the coming weeks.
Maybe by the time people watch this, it'll be out. And so a lot of the focus of that paper is on our debt and what's happening there. So maybe we can go into that a little.
Yeah, it's an issue that I think is underrepresented in the media. And I'm glad you even framed it around short-term versus long-term. Most of what the media talks about are short-term phenomena, things like geopolitical risk, inflation, interest rates, and those are, of course, things we pay attention to. But we've talked about a lot in recent market commentaries. There's a lot of noise in that data, and too much attention focused on those short-term issues, not enough attention paid to some of these long-term issues. So specifically debt, we have a very leveraged society. I'm specifically talking about US federal government debt. This is something we've talked about in years past. But to put, again, these numbers in context, there are, I had to look it up, 195 countries in the world. If you rank them from best to worst in terms of the amount of debt on the country's balance sheet in relation to the size of the country, we rank 186th, so 9th worst. The other countries that are sort of right a little bit worse than us, countries like Venezuela, Lebanon, Greece, to name a few.
I mean, not the best group to be in with.
Yeah,
from a debt standpoint.
Yeah, so from a fiscal health solvency point of view, I mean, we're not in great shape.
Yeah. And so now looking forward, those higher interest rates, I think are really affecting also how it affects just our spending and things like that.
Sure.
One of the concerns that we hear a lot from clients is that we are mortgaging our future, right? Clients with kids, grandkids, what does this mean for the next generation and even the one after? And so of late though, our debt statistics have been absolutely exploding.
They really have. They've gone up. I mean, to some degree, if you think of a chart of our debt levels, it's almost like a hockey stick going up. In 2002, again, to put these numbers somewhat in context, historically speaking, our federal debt level was roughly $6 trillion. Fast forward to today, $34 trillion in 20 short years. So, I mean, really, in our country's history, 200 plus years took us 200 plus years to incur $6 trillion of debt. We've literally quintupled it in, call it 20-ish short years. That path, that pace is continuing. Our yearly deficits, how much we're adding to the debt on a yearly basis, roughly $2 trillion. And what does that represent as a size of our economy? That's roughly 7% of our GDP. And I just illustrate that number because historically speaking, that's really off the charts. Typically, you only see numbers in the high single digits in terms of deficits as a percent of GDP in times of wartime or recessions. Our economy's growing right now. Unemployment's low, yet we're spending to that degree. What happens if we hit a recession? And you could see those deficits balloon up even further.
And so higher interest rates, though, are exacerbating the problem.
That is a big part of it. So to your point, on that $34 trillion of debt, we have debt service, right? We have an interest coverage that we have to make, interest payments that we have to make along the way. That amounts to about $900 billion, close to $1 trillion a year. Just a few years ago, that number was $300 or $400 billion, a lot less. That number now exceeds our military budget. I mean, so the only budget line items that exceed that $1 trillion are expenditures for Social Security and Medicare. So talk about wasteful spending. I mean, it's $1 trillion going out the door just to service our debt. Also, that number is likely to go up because the average interest rate on this debt, we had the luxury of very low interest rates in recent years. It's a little over 3%. But the new debt that's rolling over and being refinanced is closer to the 5% range. So even if we don't increase our debt levels much, just because of higher interest rates going forward,
it's going to keep increasing.
It's going to keep increasing. Yeah.
It's I guess you hear the number 34 trillion and intuitively that it sounds very big. But it is hard to, I feel like, contextualize that. And you did a nice reference in the paper, taking that to the average taxpayer that I thought was helpful to understand that better.
Yeah, so the average taxpayer makes, let's say, in the $60,000 to $70,000 per year and pays roughly $14,000 or $15,000 in taxes a year. So what is their share of that $34 trillion of debt if they had to write a check to pay off that debt? The answer is $270,000. I mean, just an incredibly large number for a taxpayer that is only paying $14,000 or $15,000 a year. Now, one interesting wrinkle to this, although it's a pretty big wrinkle, is that $34 trillion that we're referencing, that actually does not include the obligations, in essence, the future liabilities we have for Social Security and Medicare. Those are kind of off balance sheet. Yet, those are obligations we still have to pay, those unfunded liabilities. The Department of Treasury recently came out with an estimate of those future liabilities, $70 trillion. So if you add that $70 trillion on top of that $34 trillion, I mean, we're talking literally $100+ trillion of debts and obligations we have. So now that average person who owes theoretically $270,000, it's north of $800,000. I mean, we can see how this is just unsustainable. And while, I mean, we all know these entitlement programs, something has to change. These are, again, unsustainable. We can't pay our bills over time.
Well, so related to that, though, there are various potential options or solutions for how we can move out of the situation or at least improve it over time.
Yeah.
So a lot of them are not as maybe realistic. So starting with, I guess, the rosiest scenario or the one that would be the best for everybody is growth. So if we as a country just grow more, can we grow enough to pay down or off these debts over time? And I think just from a pure math basis, the answer is unfortunately no. So we've been growing our economy at about 2% per year. That's been kind of the average for a while
Going
now.
back to like 2008.
Yes. And so now if you go back, though, let's say that we grew at 3% a year. So back like in the 80s, we were growing more at 3% a year. Or even back in the 50s with the baby boomers, closer to 4% a year. Those were robust growth periods. Even at those levels, it's just not enough. Like the debts are too big.
Yeah, going back to the example of the individual taxpayer, that taxpayer, even a growth scenario, instead of making $60,000 or $70,000, are they making $80,000, $90,000, $100,000 a year? Maybe paying instead of $14,000 a year in taxes, maybe they're paying $20,000 or $30,000 in taxes.
It's just not enough.
It doesn't move the needle enough. So second option is austerity. We can spend less, right? You laugh. I know it's kind of funny, right? It's not realistic. We talk about entitlements, other spending measures. We don't really hear any politicians who are singing this tune. We think someone who was promoting austerity is really, to some degree, unelectable. It's really up to the populace, and we don't think the populace is ready for austerity measures, at least in the current environment. So that, to some degree, is off the table for now.
Another option potentially is higher taxes. So we could, we talked about growing, we talked about spending less. You could also make more, and one way to make more is that you just, you charge the existing, level of growth at a higher rate
and bring in more revenue.
Exactly, increase the revenue. But even then, again, the numbers, there's not enough wiggle room basically to make a dent. So think about right now, you mentioned $2 trillion deficits. That's basically comprised of about $5 trillion a year in annual income for the government. And that's mostly taxes. For our purposes, we'll just assume that's taxes. And then we're spending $7 trillion. So that's where that $2 trillion deficit comes from. But now looking at it and saying, okay, so let's say that we raise taxes 20% across the board, which is, it would be complicated. It would have effects.
That would be a big tax rate.
It'd be a huge tax rate. It would have, potentially, does that cause a recession or have a major impact on the numbers? But let's just say, for argument, it just increased. So now you have $6 trillion, right? You're still running $1 trillion annual deficits. It's just not enough.
Yeah, it just doesn't move the needle enough. So we talked about growth, we talked about austerity, we talked about taxes. Potentially there's going to be some combination of all three, but again, we don't think even a combination is really going to move the needle. That comes down to the fourth option, and we've talked about this in recent market commentaries, inflation. We do think inflation is the path of least resistance and the likely path to help us get out of our debt quagmire, if you will. And why is that? If you think about being a debt holder, the easiest way to get out of your debt burden is with inflation. Let's say you have $100,000 in debts, maybe a mortgage. Would you rather pay off those debts now or with cheaper debased dollars from inflation 20 or 30 years in the future? It's that one. And so that's why we think in a lot of ways the government, they won't come out and say this, but they really are incentivized to promote at least moderate inflation. Don't get me wrong. They don't want high single-digit inflation.
And too much panic.
Too much panic, too much pain. But will they be comfortable with 3, 4, or 5% inflation to debase our currencies over time so we can pay these debts down the road with cheaper dollars? I think that is a likely scenario.
Yeah. So the government has their options or their potential solutions. Doesn't sound like any of them were that great, but they're out there. And so now I think we as investors, we have our options, right? How do we want to position ourselves in this environment where uncertainty is heightened and there's no known timing, right, of when all of this happens or when we feel the effects of this, I think, directly, or where the market reacts to it. But look, in times of uncertainty, it comes down to, do you want to own financial assets like stocks and bonds, or do you want to own real assets? Yeah. And so real assets, again, that's where people tend to flock in times of uncertainty. And the uncertainty right now isn't just the debt. Think about geopolitical risk. We have all the different conflicts that are happening out there. A potentially contentious election.
I knew where you're going.
In the
just
U.S.
a few months away.
And so with all of that there, investors have to ask themselves, again, do you want to own something real versus a financial asset? The real assets are examples, things like real estate, things like commodities such as gold. And so gold as an example is doing really well this year. And people ask us why. To a large degree, I think it is this environment. It's this environment where there are concerns and uncertainty about debt, and there's concerns about all the other different things happening in the world.
I'm glad you hit on this concept of real versus financial assets. Those are really the two main buckets that investors can choose from. And of course, a diversified portfolio is going to have a blend of both. Real assets, it's somewhat intuitive to understand. A real asset is something you can touch and feel. You mentioned real estate and gold. Financial assets, it's a term that's thrown out there in the investment community and media. Not quite as intuitive. All it really means, and you mentioned like stocks as an example, stocks are a great example of a financial asset. A financial asset, in essence, is you are betting on the financial outcome of something in the future. So when you think about buying a stock, let's say Apple, Starbucks, you name it, you're betting on that company's ability to execute on its business plan, grow, execute, grow its earnings, grow its dividends over time. You're making a bet on the future, and that's great. And we, of course, do some of that with our stock portfolio as well. Very different than real assets, which are not about a bet on the future. They're a bet on the present, in essence. And not really a bet. They're basically relying on the security of assets that have value here and now.
Right. And then if you can have a real asset that's generating cash flow now that you can actually live on, in a lot of ways you can have your cake and eat it too. And it's really, that's kind of the sweet spot.
And that is the environment we're currently in. Because often investors flock to real assets. The 1970s are a great example in times of uncertainty and inflation, out of fear, out of concern, searching for resiliency and safety. And that's understandable. And we think there's potentially going to be some of that. But on the flip side, there's also opportunity as well. And we've been talking a lot about this in this rising interest rate environment, where we're able to lend at what we believe, really nice high interest rates, high single digit to even low double digit rates, with a focus on real assets that we're lending on. To your point, cake and eat it too. We do think we have the resiliency on the one hand with good growth on the other hand as well.
And it's not all or nothing. It's never going to be, right? We're in an environment where stocks continue running for some time, despite all the uncertainty like they did last year, like they did in the first quarter. But given that we're getting paid so well in some of these other assets, it just makes a lot of sense to diversify and have exposure to everything.
Yeah, I couldn't agree more. So really enjoyed this conversation, Meghan. And thank you all for tuning in, and look forward to connecting with you on the next quarterly review.